Okay, so you want to own an airline. Warren Buffett spent 40 years publicly calling airlines a terrible business. Then, in 2016, he invested $7.7 billion into 4 of them anyway. 4 years later, he sold everything after losing billions. Which is strange, because aviation is one of the most important industries on Earth. Airlines move over 4 billion passengers a year. Entire economies depend on them. Global tourism, business travel, international trade, all of it relies on commercial aviation. And yet, historically, airline investors have been destroyed more consistently than investors in almost any other major industry. By the end of this video, you'll understand exactly how airlines make money, why flying passengers is barely the real business at all, and why the most valuable thing Delta owns isn't a single aircraft. There are basically 3 levels to this business. At the bottom, regional carriers, small fleets, short domestic routes, usually operating flights on behalf of a bigger airline. You've probably flown on one without even realizing it. The plane says United or American on the ticket, but the actual operator is a completely different company flying under contract. You can get one of these operations airborne for maybe $20 to $50 million. Margins are thin. You're completely dependent on whichever major airline feeds you passengers. Then there's the mid-tier, budget airlines. 40 to 80 narrow-body aircraft. No free meals, no lounges, no unnecessary complexity. This is where the economics of aviation become visible. And finally, the top tier, legacy carriers, international routes, hub airports, massive fleets, loyalty programs with tens of millions of members. To compete here takes billions. But here's the strange part about those aircraft. Most airlines don't actually own them. The world's largest aircraft owner isn't Delta or Emirates or American Airlines. It's a leasing company called AerCap. They own more than 1,700 aircraft and rent them to airlines all over the world, because buying a $200 million plane that can be grounded overnight by a pandemic, regulator, or geopolitical crisis is financially terrifying. So most airlines lease, which means even the planes themselves often aren't really theirs. There are basically 3 ways in. First, start from scratch. Apply for regulatory approval. Build a fleet through leases. Hire pilots, cabin crew, mechanics, dispatchers, and then spend years burning cash before your first passenger ever boards a plane. Most startups never survive this phase. Second option, buy a struggling regional operator. Small airlines become incredibly fragile when they rely too heavily on one major contract. If that partnership disappears, the entire business can collapse almost overnight, which means distressed airlines occasionally become available at steep discounts. But the third path is the most important one, bankruptcy, because airline bankruptcy doesn't usually mean the airline disappears. It means the airline gets reset. Delta filed in 2005, United in 2002, American in 2011. Debt gets wiped away, labor contracts get renegotiated, costs get restructured, and investors who buy during the collapse sometimes capture the upside without paying for all the damage that came before, which leads to one of the strangest truths in aviation. The best time to buy an airline is usually right after it's been destroyed. Now, let's say you own a mid-sized budget airline. 50 aircraft, routes operating normally, planes fully booked. You are still burning millions of dollars every single day. Fuel alone can represent 20 to 30% of your operating costs, and you control absolutely none of it. If oil prices spike, your margins can disappear almost instantly. In 2022, jet fuel prices doubled in under 6 months. Airlines with fuel hedging contracts survived relatively intact. Airlines without them watched profitability evaporate before summer even arrived. Then, labor. A senior pilot at a major US carrier can earn several $100,000 per year. and replacing them isn't quick. Training a captain takes years. So when pilot shortages happen, airlines can't simply hire their way out of the problem. Then aircraft leases, maintenance, airport slots, gate fees, insurance, ground crews. A mid-sized airline can easily burn $3 to $5 million per day before selling a single ticket. And maintenance is non-negotiable. Miss a mandatory inspection and the aircraft gets grounded immediately, which creates one of the most brutal dynamics in aviation. A grounded plane still costs money. The lease still exists. The staff still need paying. The airport fees continue, except now the aircraft generates zero revenue.
At first glance, airlines make money by selling seats. That's true, but it's not where the real economics live. The first hidden layer is ancillary revenue, checked bags, seat selection, priority boarding, flight changes, on-board purchases. Last year, American Airlines generated billions from fees alone, and those fees are incredibly profitable. Sometimes the cheapest ticket on the plane barely makes money at all. It simply gets the customer into the system, because once they're booked, the airline can start charging for everything around the flight. But even that isn't the real business. The deepest layer is loyalty programs. This is where the industry becomes genuinely strange. Airlines sell points to credit card companies, not to passengers. American Express reportedly pays Delta billions every year to issue Sky Miles through its credit cards, and the airline receives that cash up front, often years before anyone redeems the miles for a flight. Then in 2020, during the pandemic, Delta used its Sky Miles program as collateral to raise $9 billion in financing. At the time, analysts valued Sky Miles higher than the airline itself, which completely changes how you see the business. Delta is not an airline with a loyalty program. It is a loyalty program that operates an airline to keep the points valuable. There are three things most people get completely wrong about airlines. First, people assume premium airlines are the most profitable. Usually, they aren't. Budget carriers like Ryanair often generate much stronger operating margins than traditional legacy airlines. Why? Simpler routes, faster turnarounds, lower staffing complexity, no expensive luxury infrastructure. The business model that looks cheap often produces the most cash. Second, people think flying passengers is where airlines make their money. But at many carriers, ancillary revenue contributes more profit than ticket sales themselves. The flight is the product, the fees are the business. And third, people assume airlines own their fleets. Most don't. A huge percentage of the global airline industry operates on leased aircraft, which means many airlines are effectively renting the core infrastructure that keeps them alive. Pan American World Airways was once the most prestigious airline on Earth. Pan Am pioneered transatlantic jet travel, helped launch the Boeing 747, created the image of luxury international aviation. For decades, the blue Pan Am logo represented modern air travel itself. Then, everything started breaking at once. Airline deregulation created new competition. Oil shocks destroyed margins. Debt piled up. And then came Lockerbie. December 21st, 1988. Pan Am Flight 103 exploded over Scotland after a terrorist bombing. 270 people died. The reputational damage was catastrophic. Passengers stopped trusting the airline. Pan Am sold routes, sold airport slots, sold assets, sold its headquarters. Nothing stopped the collapse. In 1991, the airline shut down permanently. And the lesson wasn't simply that Pan Am was badly managed. For years, it wasn't. The real lesson was this: an airline can spend decades building its reputation and still get destroyed by a single event completely outside its control. That's the terrifying part of aviation. Your downside rarely has a flaw. Now imagine the optimistic scenario. You build a successful budget carrier, 50 planes, high passenger loads, strong ancillary revenue, tight operations. You're generating over $1 billion annually with healthy margins. This is essentially the Ryanair model. Take a small regional airline, strip away unnecessary complexity, maximize aircraft usage, and turn operational efficiency into profit. Michael O'Leary transformed Ryanair into one of the most profitable airlines in Europe using exactly this approach. But now the realistic scenario. Fuel prices double, travel demand weakens, pilot shortages worsen, interest rates rise. Your costs explode while ticket prices stay locked in on advance bookings. Every flight suddenly loses money. And unlike other businesses, airlines can't easily pause operations. The planes still exist, the leases still exist, the payroll still exists. During 2020 alone, the airline industry burned through more capital than it had generated in the previous decade combined. That's how brutal the economics can become. In 1971, Southwest Airlines started with 3 planes flying between Texas cities most competitors ignored. No luxury cabins, no complicated route network, no prestige, just fast turnarounds and constant utilization. And while dozens of famous airlines collapsed over the decades, Southwest remained consistently profitable for nearly half a century. Because the airlines that survived weren't always the most glamorous. They were the ones that understood the business earliest. The money was never really in the flying. It was in everything surrounding the flight. The loyalty ecosystem, the fees, the financing, the infrastructure, the customer relationship. The plane ride itself is often just the mechanism that gets you into the system. Because in modern aviation, the flight is really just the reason they got your credit card.